Good morning, all. It's a Wednesday. Market's a little bit choppy this morning. ES and QRTY rebounding from the close. Still, things are a little bit at a deadlock, though. We'll talk a little bit more about that today. Stocks last night. MSFT, nice little rally there. Oracle inching higher as well. Those software names do rather like. The rest of the market, however, is struggling. And is technology stocks going to keep the market up as well as they have? We shall see. Commodities, a little bit, good for risk assets with oil trading lower, of course. Metals getting a lift, dollar lower, Aussie Kiwi the strongest. Yen also getting a bit of a lift as well, very much linked to oil. Just a little bit of a reversal from yesterday's action. We had some inflation data from the UK, which was, not as much as expected, but it's not heading in the right direction. We have EU consumer confidence much later into the US session. A few central bank speakers, Lane, some ECB speakers that are not there on the list. Not a lot more. I think EU consumer confidence, as we are seeing with a lot of the consumer confidence data, they're all coming in weaker due to this whole oil thing. So maybe Euro short side is the one to keep in mind for today, and easy to kind of hold through the event, knowing that it's not going to surprise to the upside. And then we have some flash PMIs tomorrow. So yeah, we'll be looking at some crude at the end. I think the chart is looking still quite constructive. I think there's reasons to think that it will stay constructive. Equities and metals, yeah, momentum is clearly weakening. And because of both of those, I think dollar will still, that support will still stay in play. BTC also looking quite constructive as well. A quick look at it. Yeah, it's up at the highs. So 78K does look like it still wants 80, that 80K region. Yeah, which would look quite natural technically from a purely chart perspective. So yeah, BTC, it's sentiment strong there. Tells you something about sentiment, I suppose. Diving into, actually to start, before we get into the news flow, I want to cover what the analysts are saying about the oil market. The narratives, they aren't new, but I think it's getting even stronger and worth a look, just because things are just getting dragged on day by day. So starting with this one, this is from HFIR, titled Breaking Point, expanding on his previous article. And it's the idea that supply outages will start to show up in inventories. Basically, that breaking point being a tipping point for global inventory collapsing. He estimates that crude oil storage will be below 400 million barrels and approaching the operational minimum of 373.80 by the end of July. And that would represent significant risks of a material supply shortage. So thinks he could get there by the end of July. And as a result, the US will probably have to start banning crude exports. We're already seeing a few countries banning or curbing them, at least. Even if the ceasefire does end with a peace deal in place, there is still this issue of supply just being very tight, because the drawdown in inventory is pretty much guaranteed, he's saying here. For these tankers to return, it will take 20 days. Time it takes for VLCs to load will be 68 weeks. Transit time to Asia will be another 45 days, etc., etc. So it's basically centered around this idea that it takes time. There's logistical lags, tankers getting around. There's still plenty trapped in the west of that strait and all trying to get out. And by the time they return, and all that kind of stuff. So a lot of logistical lags that points to a situation where even if we get a deal now or tomorrow, there's still a big risk of inventory drawdowns that makes things very dicey. This one from Sparta, basically more of the same thing. It will be months before the supply chain is normalized, and we're seeing that supply chain of impacts affecting everything now, even condoms, which, funnily enough, might be inflationary too. I don't know, but yeah, it's affecting everything: packaging, lubricants, plastic bags, even in Korea, as I mentioned, inventory draws, etc. Won't really go into too much detail. U.S. oil inventory getting started in earnest now, quite imminent, that risk. Inventory, U.S. tightness going forward, etc., etc. So watch supply, watch the commercial inventory data, the EIA data, and things like that. And if we do see huge draws in them, that's a sign that all this thesis is becoming more of a reality. More of the same. Asia also obviously suffering quite a bit. Oil prices don't reflect scale of supply hit. Analysts say the scale seems to be something where the market can actually get its head around. It will take time for flows to return to normal. Real disconnect. Citi sees oil at 110. If disruptions last another month, could go as much as 130 on a 2-month disruption. So that would take it to new cycle highs. Cycle high on WTI spot was 120. Asia's largest oil buyers are running low. Recessionary impact, DHL warns of a tipping point. So jet fuel clearly impacting supply chains in more ways than one. Gas station retail sales, big pop there. You haven't seen that kind of surge in however far back this goes, but in terms of what we see here in this window, that's the biggest surge, monthly surge we've seen in a while. Nitrogen prices taking a surge up. Jet fuel prices, United Kingdom are huge net importers of jet fuel. Germany up there, Asian countries, France, Italy. In terms of macroeconomic impacts, more cautiousness from companies, growth impacts, business optimism, all that confidence stuff. We're getting EU confidence later. Finland, obviously rises. So lots of macro concerns and stagflationary risk building. Air passenger growth, luxury items, condoms even, and all that kind of downchain stuff from these byproducts of crude oil. But U.S., even if we look at the ex-autos and gas retail sales, spending has been strong. That points to, so these are the PCE numbers, and this is the retail sales control group, which feeds into PCE metrics. And usually, it does tend to correlate quite well. And we also saw the PPI components and airfares and some healthcare components also having a bump up in March. So March PCE is looking quite strong. So that's going to keep the narrative around the Fed being more patient, of course. In terms of macro to sort of micro themes, energy, defense, probably going to be a strong theme for longer. And obviously a much more durable theme is memory stocks and chips and things like that, AI gear, super cycle even. I don't think it's really even a debate. I think we are going to see it. I think we are in a super cycle given how AI is just, whether or not they're going to be profitable, whether they're or not, how much debt they have, it's going to be around and it's going to change the way the world is really. So yeah, I think I would definitely agree that we are in this sort of memory stock and chips sort of type of super cycle. AI is only going to get better. It's only going to compute harder, and we're going to need all that gear. UK inflation data. This is slightly different. So if you look at the 12-month one, it will be slightly higher than the what you get on the calendars. But this is the HICP methodology I use because it's what Europe uses, and I like to analyze what the relative is between Europe and the UK. That euro pound kind of thing comparison, and that helping with which one's the better one to pair against something else, or for example. But the important thing is that we are seeing a rebound, and UK data actually has been quite decent on the whole. It's been holding up quite well. But yeah, latest PMIs, I believe, was starting to show weakness, but yeah, I mean, I think on general, it seemed quite okay. Employment data just yesterday was okay. So yeah, it's looking a little bit hawkish for the BOE on balance. BOJ. So more of the central bank type of stuff, emphasizing this sort of uncertainty and kind of a wait and see mode. I'm not sure that really matters for the BOJ as much because they are just on a normalizing path anyway. But recent data hasn't been all that great for Japan, but they are still quite behind the curve. Market was heavily leaning towards an April cut, and yeah, it's pared back a little bit. So I think that's probably adding to a little bit of yen weakness that we saw in the initial couple of days. More kind of RBI, Bank of England, India. Asian FX is showing a little bit of capital flight to the dollar in a way. Obviously, dollar is being favored. And the yuan rally, it's been quite strong. I think, China will have to start to allow the yuan to kind of weaken a little bit. Not sure. They are seen as being one that benefits from these higher oil prices because they've aggressively stored up a lot of oil. But I don't think it's in China's interest to leave the yuan too strong, especially as demand slows. So, you don't want your exports to be too expensive. And then moving on to the news flow now. This is where we're at. Directed the military to continue the blockade, but will also extend the ceasefire until such a time their proposal is submitted. Iran doesn't want the Strait of Hormuz closed. They want to save face. Sure, Iran wants to open up the strait immediately, but if we do that, there can never be a deal. So it really shows what Trump is thinking about the blockade. There's a lot of news saying that he might actually think about lifting it, but he actually thinks that this is the leverage that he needs to have to get a good deal or a deal of some kind. Iran is collapsing, starving for cash, etc. Okay. Report from the BBC initially that Iran's UN ambassador, who's in New York at the UN, has received signs that the US is ready to end their blockade. I call BS. Doesn't really seem like that's the case, especially with Trump's last True Social post. That's delaying his departure. Not canceled it, though. Is in effect pause. More stuff going on in the Strait of Hormuz. America assaulted 2 Iranian ships. It's boarded one, seized one. IRGC talking as if they won't put up with it. Have to say goodbye to their oil production in the Gulf states. Aragachi, more of the same, really. Iran violating ceasefire numerous times. Iran has actually been saying that all along as well, starting with the Lebanon being part of the initial ceasefire terms and Israel just continuing to bombard southern Lebanon. Strait of Hormuz, traffic has kind of dipped down. It's a little bit weird, as we'll see in an FT article, but yeah, still nowhere close to these sorts of levels. A little bit more chatter around the Houthis. If they get involved, things will get a little bit tighter, of course. We'll have to see. And this one is interesting. Some tankers have been able to get through, and Trump has been saying it's a tremendous success, but tens of ships have managed to circumvent the blockade, according to this tracking company. At least 19 tankers, at least 15 have entered the Gulf. At least 6 of those which left was carrying Iranian crude oil. So, bottom line, I guess it's not exactly clear what the numbers are in terms of Strait of Hormuz traffic that's being reported, but isn't anywhere near normal levels and levels that's enough to start alleviating supply shortages. Some interesting stuff from Anas, talking about this incident in the Indian Ocean, far out from, this whole Persian Gulf, Arabian Sea area. And here, there was something going on, the U.S. getting involved there. And if the U.S. is starting to do that, then his thinking is that this will likely prolong the blockades and the maritime sort of standoff, if you will. So that's pretty much it. That's where we are. And yeah, I finally want to just touch on this, which I've posted the link in the strategy channel, I think it was. I've basically summarized it into these four stages that he talks about. And I think it's a very clean way to think about market narrative regimes. And, it's something that ties into how I think of certain regimes and frameworks about stagflation, for example. But four stages here. I think the first two is largely, I would group it as one, and then three and four sort of together. So two halves with two sub-regimes, if you will. The first half being, event-driven, narrative-driven, a lot of volatility. It's not fundamental. Lots of up and downs, fast and in and out sort of trading, judgment and timing dominated, being very reactive. And then the second one being a little bit more about fundamentals, being a little bit more about equilibriums and who the winners are and the structural shift. And if you think about the current regime in terms of how I've been approaching it from a macro perspective, to say that the stagflation regime comes in two parts, right? We first have to contend with the inflation sort of narratives, and then later we contend with the sort of longer term growth impacts and the, those types of narratives. And I think this really ties into how that is, right? We're now having to deal with the oil and inflation type of shocks, and it's very, very much very headline driven to trying to assess how big the damage is and how long, and that's predicated on how long the conflict goes on for. And then later on, we can, once that becomes clear, then we can start sifting out the relative value trades will be a little bit more clear. So for now, I think we're still very much in these sorts of phases, shifting between 1 and 2. A lot of volatility, very, very headline driven. Probably shouldn't be too greedy with these trend moves. As I think that's where I've been kind of going wrong, watching perfectly good trades, and should be taking advantage of the volatility a bit better and the back and forth headlines. And definitely not really fundamental at the moment. Although we are thinking about it, it's still not clear how this fundamental picture is going to look. Although oil is starting to shift into something like this. So I still think we're between 1 and 2, and it's a really good post. So worth a quick read, in my opinion. So with that, we'll look at a few charts. Obviously, starting with oil. I think it's really starting to build a nice base here. Get a clean chart. And we looked at these lows. We looked at this consolidation structure, and we've broken out. And now we put in a higher high above this previous high as well. So market structure is changing now into higher highs and higher lows. This level here is quite an important pivot level. We had a little bit dip below, but as long as we're holding these sorts of levels here, I think it exposes further upside moves, and this base being done. Obviously, we can get a headline or two that makes it sink lower, then in which case I would think that's a gift. Just relying on this overall structure kind of holding up. So very, very nice shouldering action and potential another leg up to the upside. So just loosely speaking, you take this sort of measured move and, sort of target some of these areas. So I think that's very, very possible. The narratives are also good as well. Metals does just really looks like it wants to trade higher all the time, but I do like these levels here still. It was a key level that we started to lose momentum and started to kind of roll over a little bit, had another peak higher as well as did it here, but it didn't really amount to anything. So it still looks quite weak to me. We've lost this level the last time, so I think this already, going by that, is already looking like very decent levels to lean off. SPX deserves a look. That structure, you have that inside bar, and now we have this bearish engulfing. So very, very toppy looking structure. NDX not looking as bearish, but yeah, does look a little bit toppy as well. A little bit of sort of Twin Peaks going on with Yeah, we'll have to see if we trade lower. It looks like it needs to show a little bit more. Pardon me. XLK. Yeah, highs have been getting very, very shallow since Friday. So we haven't really been able to make progress on the Friday highs. Understandable given the weekend news flow. So that's equities. What else? DXY. I think the support. You know, I'm just loving this. How this is all looking. I'm loving how all the risks from oil. So yeah, from a macro and technical perspective, this is just looking very, very nice, and that's why I'm willing to build up on a position, on a long position, swing position, long, and Euro USD. Obviously, DXY in reverse, losing some key levels, fading from the 61.8 retracement, so looking very, very good there. Pound dollar, I'm in, and very, very similar look there as well. Aussie dollar is looking just very, very resilient, and but still not as clear. Maybe euro dollar and pound dollar are a little bit more clearer in terms of the technical picture. Dollar yen has seen a nice move higher, but it has flopped over a little bit. Didn't reach the 160 yet, but looks interesting in some way. And I still think dollar yen, the natural path is still very much higher given the other narratives around oil, conflict lingering, and so on. So anything else before? I don't think there's too much reason to get into everything else. Take a look at the heat map. Yeah, Aussie coming off a touch. Dollar kind of coming up a little bit. Yeah, it's all really oil. You got to look at this and think that's very, very constructive. And then you got to look at the news flow and the what the oil market is thinking about, as we've seen in covering the analysts before. Yeah, expect it to stay supported. So yeah, risk is to the upside. Dip should be bought, and oil dollar weakness should be faded, in my opinion. And I think that's going to be a relatively high conviction sort of overarching sort of bias to keep in mind going forward. So I think that covers everything, and we can wrap it up there. And we'll speak to you all in the chat. Cheers.